It's just gone good afternoon. So we're just over midday. Welcome to everyone to this webinar. My name's Jackie Broman from TBA Law. So thank you for coming along to this special guest webinar presentation we have Tim McCarthy from Sage Business Accounting, and he's talking today about primarily capital gains tax, but other taxes as well, and understanding how the taxes apply, particularly to hobby farms, rural lifestyle properties, which are becoming so popular on the outskirts of Melbourne. But there are some consequences, which we'll find out. And I suppose things just to watch for and manage, because we don't want to discourage this lifestyle, do we, Tim? We just want people to be aware and have their expectations met and know what they need to manage. So I'll pass over to you and your wealth of information. Now, for those here live, of course, use the Q&A button, please, to ask questions. Because this is a webinar, the chat is disabled, so the Q&A is the one to use. I'll monitor that as we go, and I'll interrupt him if we need, but otherwise most of the questions at the end. And for those watching the replay, we'll share our details at the end so you can email us any questions.
Awesome.
Take it away, Tim.
Nice. Thank you, Jackie. And I guess more than anything, I want to say thank you for the opportunity to have a chat today around this topic. It's not a fun topic. It's a bit of heavy lifting. There's a bit of bruising in it. And no one really likes talking about capital gains tax, or we're going to talk about also the ugly world of windfall gains tax too later on. What I guess we're hoping to get at today is reality. And reality is that we need to address these issues, we need to deal with them, and we need to have some tools in our kit bag to be able to make sure that we can get the best outcomes. I was just thinking earlier that is the one place where the legal profession, the accounting profession, and the planning profession can all come together to give clients great outcomes and great results. And just to that end, I really want to thank you, Jackie. I know you've done some amazing work with many of our clients and our team. And if anyone's on the line who doesn't work with Jackie, couldn't recommend her more highly for the work that she provides. So in all areas of law, it's just a
Thank you.
a fact.
Likewise.
So it's easy when you say facts. So let's get into this. I'll do the regular thing you have to do for a start, which of course is a disclaimer to say what I've said here, please don't take it as gospel and make sure you're working your way through it. What we're going to cover today, we're going to talk about the basics of a principal residence exemption, which most people know about, but then we're going to talk about mixed assets, and that's more likely where the problems start and finish. Not so much finish, but they all start there. The cost base and construction elements, so how we're going to minimise our tax, how we calculate it, how we apply it to ordinary income, and then we'll talk about this windfall gains tax for anyone in Victoria. We know we've got people on the line from outside Victoria, but anyone in Victoria, it's a really relevant topic, and it may well become something that other states have to deal with in time as well. And we'll talk about some opportunities and some key issues. Principal residence exemption. I think this is the one where most of us say, yep, we've got the licked. We know this one inside and out. Our home is free of capital gains tax. Simple as that. If only it was that simple. So traditionally, we've had that theory of home, no tax, you beauty. But the really important element to factor in here is the house and 5 acres. So when talking about lifestyle properties today, we're talking about people who are living on, say, anything from 6 acres through to 60 acres is probably what we're talking about, maybe a little bit bigger. So there's elements of tax to consider if your property exceeds 2 hectares or 5 acres. And that's what we're going to talk through over the next few slides. Also, towards the end, I actually want to give you a bit of insight into some exciting announcements for our business together with Jackie as well that hopefully you'll enjoy too. But let's get into this. What about my home if it's greater than the 5 acres? The common lines we get, is my home's 20 acres, but it's my home, so there's no tax to pay. And the absolute gold one that comes along all the time is, hey, my neighbour sold their place. They didn't pay any tax. Why should we? It's not about your neighbour. It's not about what they thought they heard. It's not about their circumstances. It's about your circumstances and making sure that you're well armed for the best outcomes that are possible for you and your family. Because getting this wrong can be very, very expensive. So it's all well and good for the neighbour to tell you that they didn't pay the tax, and that's fine. but we are worried about our client and our client's needs and protecting them from getting it wrong. What about this one? Oh, I run a business. Like, yeah, I've got a hobby farm. Yep, we run a business. We've got 4 chooks. We had 5 cows years ago, but then 3 of them died, so we've still got 2. And we've got a goat. I run a farm, therefore I shouldn't pay tax on that. Let's just talk about the farm. We talk a lot in our business about the duck test. If it looks like a duck, if it quacks like a duck, it's a duck. Now there is questions of fact and degree, and there's quite a bit of well, not so much legislation, but more rulings around what is a farming enterprise and what is not a farming enterprise. And we just put up on there some of the factors that are there. So look at your past tax returns. Have you been declaring that you've been operating a business? Like, if you haven't been declaring that, and all of a sudden you become a business, is that really kosher? Profit making intention. Okay, this farm, most people go into business to try to make a profit. What profits have you been making, or what business plans or record keeping? So it's really, really valuable. If you can prove that you're running a business, and we'll touch on that a little bit later, it's really, really valuable. But also, let's not get too cute. Sometimes we think we can get very, very cute around these types of topics. And again, getting it wrong, very expensive exercise. So just be aware of that. We're going to walk through an example in a moment, but I just want to give you the image on the screen there of what we're talking about here. We're talking about a home property that's greater than 5 acres. So yes, it's a single asset that's disposed under one contract. There's not multiple contracts. It could be 5, could be 15, could be 30 acres. But the tax law will treat it as if they're 2 separate assets for the purposes of this transaction. They'll say your house, and let's assume that you've lived there the whole time. Let's just leave the business to a side for the moment. They'll say the house in the 5 acres is exempt from tax. So they call it curtilage. Quite often you'll hear the term curtilage. That might include sheds, it might include some landscaping, it might include some really, really high value areas of the place. The balance is the taxable asset. And that taxable asset is what capital gains applies to. So if you own 7 acres, well then 2 acres is a taxable asset, and the home in 5 acres is exempt asset. In many respects, they use the term house, but I think home is probably more appropriate because it only applies when it's your home. If it was investment property, we've got a different discussion altogether again. So we're talking about this young, excited couple, Jim and Pam. They were very, very happy. They came and bought this place. And over the next few slides, I'm going to talk through an example of how this can all work in reality. And none of it, I think, is too far out of what would normally be the case. What I'm going to ask you is that, if you don't mind, let's not get attached to the numbers themselves, because actually, quite honestly, the next few slides, I'll do some rounding off in estimates anyway. Let's get attached to the concepts and the reasons for being and what we're looking for, because we'll all come together at the end. We'll understand how important this is. So Jim and Pam have got a 10-acre block of land in 2004, and they purchased it for $160,000. It's quite simple, 10 acres, therefore 5 acres will become the home. We build the home on it for $420,000, and 5 acres will become the taxable asset. You'll see in red we've highlighted a critical point here. There's sheds and buildings that have been added within the 5 acre footprint. They cost $80,000 over that period of time. Outside the 5 acre footprint, they've also built a dam and windmill that's cost $60,000. So now it's got to May 15, 2024. They've signed a contract. These dates are important, and we'll come through to that in a moment. And they settled on the 15th of August, 2024 for $1.7 million. And that seemed great until they went to their accountant, and now they're confused. How's it all going to work? They paid the agent $35,000. They were happy with that. And just out of interest, which becomes important soon enough, is that Jim's on a salary of $130,000. Pam's retired with some health issues. So we've got this money. We've had $1.7 million, which is coming in, and now how do we deal with it? Okay. So we know the additional 5 acres is a taxable asset. First steps first, this is our strong recommendation, is you can, under legislation, you can choose to value the two assets, the house of 5 acres and the additional 5 acres, however you choose. Doesn't legislate that say you must use a valuer. They don't legislate to even say you must use a real estate agent. You can just do it yourself if you want to. Our take I suppose, from a professional point of view, is a sworn valuation is really critical because, particularly in these high value assets, it gives you some documentation that you can sit and rely upon and say, hey, I spent a couple of $1,000s, but it was the investment because now I've got something I can rely upon reasonably. Someone's put their name to it and their credentials to it as to how they come up with the valuation. So that's our take, but it's absolutely your choice as a taxpayer as to whether or not you want to go down that path. So in this example, they decided that the house of 5 acres was worth 1.3 million, additional 5 acres, 400,000. So roughly a 75, 25% split between a taxable asset and a non-taxable asset. This is the quirky part. Let's get through it. So it's the heavy lifting part and the bit of the ugly piece. We'll handle this for a few minutes. It'll be some more enjoyable after that. The land is 5 of the 10 acres, so therefore 5/10 of the original 160. We're building a cost base here. We're saying, what did it cost us to actually, that 5 acres of the taxable asset, was that outlay we've spent on that? Because we know the sworn value has told us it's worth $400,000. So the stamp duty on the purchase price was just half because it's just a piece of land. Simple. The legal fees was half. Same thing, 5 out of 10 acres because it was just land at that stage. The dam and the windmill, $60,000 because remember they were outside the 5 acre lot. The agent fees. So now we've got into the calculations. 35,000 was paid the agent. However, we know that 1.3 of the 1.7 million was a tax-free asset. So we only include the quarter left over. There's another one here, holding costs, and referred to often as a sneaky third element because it's called the third element of a cost base. And why it's sneaky is over a period of time, you'll have paid a number of costs. In this case, Jim and Pam will have paid a number of costs just to keep the place in their name, rates, insurance, and the like. If you've purchased the property after 1991, so I'd say now probably that's most properties we're talking about in this discussion, but if it's before 1991, different set of rules. But if you've purchased post 1991, then these holding costs can actually be added to your cost base. And they can make a huge difference, particularly if you've been borrowing money for the purchase of the property. So if we look at that, what are these holding costs? The interest on loans, rates, land tax, insurance, water rates, any repairs you've had to the property where you've done it, again, outside that 5 acre envelope, and they've been repairs that you haven't claimed any tax. So one of the key principles here is you can't double dip. If you've already claimed it somewhere else in the past in your tax return, we can't do it twice. But let's go this time. So council rates, how would you calculate that? Well, again, it comes back to that $400,000 taxable asset over the 1.7 mil, we'll claim that. The water rates, well, this is the thinking that goes into it. This has been $10,000 spent on water rates over that period of time. However, of that, 0% will be, it's the cost base because the water supply outside the house and shed was a dam out the back. Land tax, well, there's no land tax charge, but if there had been, it'd be 50%. And with the insurance, $20,000 been paid over the period, but and I had to look through the premium, 3% of the premium related to the property. Again, there's a taxable asset. So we're thinking through our ways there. What about the borrowings? The borrowings are often the biggest one to think through. So if we go back to the start, the original purchase, we'll claim 50% of that land because 50% of that land is a taxable asset. We're basically marrying up costs. The home, they borrowed $400,000 to build the home, but that's not going to be deductible at all. So if we can't claim any interest on that. And then the sheds, dam and windmill, they took out another loan to fund that. And the proportion that relates to dam and windmill is considered a taxable asset, but the part relating to the sheds isn't. So we're just looking at essentially here anything cost that's incurred in holding or maintaining that 5 additional acres in this example. So it's a yuck slide, this one, because it's way too many numbers and not very exciting. Let's say the capital gain we ended up working out was $180,000 because we said the cost base of all those elements brought together was $220,000. A gain of $180,000. This is where the actual tax calculation comes in. The gross tax capital gain will be $90,000 each for Jim and Pam. Now it's at that point where we separate it out. So this doesn't matter whether it's for a property or any other asset at all. Capital gains tax doesn't exist in a partnership. It's the partner who has the capital gain. So it's important to separate at that point in time. So if we follow down from Jim's example here, he's got $90,000 gain. $45,000 of that, half of it, is tax-free because he's owned the asset for more than 12 months. So therefore, taxable asset's $45,000. That gets added to his other income to create a taxable income of $175,000. Exactly the same for Pam, other than the fact that she has no other income, and therefore her taxable income becomes $45,000. So we've got two very, very different tax outcomes. Essentially, Jim's $45,000 is going to be taxed at 39%, whereas Pam's is taxed based as if she just earned $45,000 for the year, which will come in at around about $5,000 in tax, so significantly lower than Jim's. So that's what we're talking about calculating the capital gain and working our way through there. But let's remember one more thing. There was that business that we touched upon earlier. The exercise we've done there has to be done regardless of whether you had a business on the property or not. If though you did have a business and you operated that business at some stage through there, and there's rules around this for 7.5 years or half of the time that you own the property, there's a whole lot of technical rules around this. But if the evidence says you have operated a business, it's actually quite possible to end up applying the small business capital gains concessions. Now, that's a whole other discussion point, but I want to raise it because it's important. It's important in the sense that you go and get the advice around there because the big outcome, potentially you pay no tax at all on the sale of a property if you're eligible. Now, to turn around when you sell the property and say, oh, yes, I was in business and no evidence supports that, is going to be a hard sell. But if we think about this, let's say you've got a property now, so thinking about this when we're not for sale. What am I doing? Am I really operating a business? Am I running some sort of intensive farming operation on 20 acres? And so the size of the land doesn't have to be the defining factor as to whether or not you're in business. It's the intensity of the operations that is far, far more important. So I just wanted to flag that as a really important area. Again, don't get that wrong and don't get too cute because that can have some dire consequences. Really important in this stage too, that you work closely with your solicitor on the documentation around there because GST is also a factor and the like, whether you're in business, there may be a particular rollover you're looking for. So it's really important.
Before we go on to windfall gains, can we touch on a couple of these questions that have come up?
For sure, Jackie. Yeah,
hopefully
definitely.
Quick questions.
Yep.
Deborah's just asked, in calculating the cost base of maintaining the property, would weed spraying be included in?
Yeah, provided it was on the taxable asset, it would be. So if you spray, so if you had 20 acres and you sprayed the whole place, well, there's 3/4 of it would be. But if it was just purely used on the taxable asset, definitely yes, for sure.
Yeah, cool. Then Joe asked a question around calculating cost base as well. So using 10 acres as an example, just like you have.
Yep.
If there was $1 million of borrowing, 5 acres of it doesn't have a home. Well, with your example, they bought the land before the house. So it's different if if it had a house on it already and it was worth $1 million, then you're going to have that valuation calculation at the beginning as well, aren't you?
Correct, you would, and you'd want that anyway. So if you did,
Mm,
actually buy a property with a house already on it,
mm,
it makes sense to get a valuation really early doors around the breakup of that $1 million purchase. So
mm,
of the $1 million was, say, let's say $200,000 was for the additional 5 acres and $800,000 was for the house and land of the 5 acres, then the interest would be deductible proportionally at a 2/10 rate on that one example, but that's probably a really poor way to do the numbers. It would be the taxable portion.
yeah.
Is
And let's hope the proportion stays the same throughout the whole of the ownership of it too.
Yeah, and sometimes that's an interesting one, Jackie, because
Mm,
sometimes that can move a lot,
mm,
because the value can really be in the home, particularly if you do renovations and the likes of the home or do them up,
mm,
can make a real difference to the proportion.
mm. Couple more questions. Running an agistment service on the rural piece, would that qualify as a business?
As long as it potentially, but I should say answer
Actually run,
potentially.
yeah.
Yeah, I should answer potentially there. The distinction being that an adjustment service requires some active behaviour as opposed to a lease of the property or a rental. So
Yeah.
if it's a passive investment whereby you're leasing the place out to a third party who then uses it, and you call that adjustment, it's not
Mm,
adjustment no matter what word you use. However, if you're running an authentic adjustment enterprise where you got people coming and going, short-term stays and the like, absolutely, that could potentially be an argument for it, for
yeah,
sure.
cool. And then 2 from Ivan.
Yep.
Ivan, will I have to keep every single receipt for the cost base over owning a property for 20 years to justify the maintenance and improvements?
My technical answer, unfortunately, is yes. Um, in terms of calculating capital gains, maintenance records, the 4 years if you look keep your records for accounting purposes and for tax purposes, for 4 years from the date of lodgement of that return. So initially, call it 5 years. The challenge with capital gains is you've bought a property 25 years ago
Mm,
and you're selling it now. Since you've got to keep the record for 30 years, that's where in the modern, well, we'll talk a little bit about that shortly. Actually, we've got a slide on that. But one of the things that's important, I think, is to think through how do I keep my records? What records am I keeping? And we'll talk about that very shortly. Yeah.
mm. And then one more question, which I don't think is either a legal or an accounting question, actually. It's about valuing a property, and is it based on zoning? I mean, and that comes down to the valuer, and that's why getting a proper sworn valuation is probably better than just having an appraisal or using your rates, because a valuer will know, what zoning will affect what the valuation of the property will be, won't it? So
Yeah, that's why we really do heavily defer to the valuer
yeah,
on that element. We don't pretend to be property experts
yeah.
because I think that'd be stepping outside our wheelhouse.
But is there any difference in tax treatment if it was in the pure farming zone versus rural living zone? For CGT, it's the same, isn't it?
No, CGT's the same. The
Yeah.
only difference would be potentially if you've got a farm operating, but the actual zoning itself
Mm.
doesn't change the tax consequence at all.
Mm. All right. Good questions, everyone.
Thank you.
We'll let
Excellent.
you continue, Tim. Thanks.
Oh, awesome. Thank you, everyone. So, and this is, for those of Victoria, this is a bit Victorian centric. If you're outside Victoria, it's probably maybe worthwhile because we have all as a sneaking suspicion that if something goes well in one state and generates revenue, it may all end up being the other states. Look at payroll tax, land tax, and the like. So history tells us this what aversion may come to other states. And we're going to keep this relatively high level because legislation is relatively new and there's proposed amendments already bills before Parliament. So this is version 1 of windfall gains tax. However, it's something to be really aware of, particularly in talking about zoning before. This is where zoning can be really critical to your outcomes. So essentially what people have probably heard about it, but the core of it is that the liability comes upon a rezoning taking place. Now, that can be any form of rezoning, and there are some exemptions around particular rezonings. But as a rule of thumb, if your property is being rezoned in such a way that rezoning will make a tangible difference to the value of that piece of land, you're probably falling under this piece of legislation. In terms of valuation, what happens is it's an assessment based upon the capital improved value. So you've got a rates notice there. On your rates notice, you'll see a notion that says CIV, capital improved value. That's the value of the property. So the uplift in that value, as determined by the valuer general, is the basis of any calculation. And the effective, and they'll come relevant in a moment. And the effective date of all of this coming into place is the 1st of July 2023. So if a rezoning took place before the 1st of July 2023, you don't fall under these rules at all. That's something really, really important, because there are actually other provisions where potentially where transactions happen pre-15th of May 2021, you may get some exemptions also. The most common exemption that we have is residential land, noting that, again, up to 2 hectares. So it's not just we own 25 acres, therefore it's residential land. It's residential land up to 2 hectares. And again, we talk about primary production land, and there's even the terminology used which talks about commercial farmland. So it may well be the definition for the income tax of primary production operation and farming may be different to the definition of primary production land for to be commercial farmland, because the point I make here is that I've highlighted in red is this is a state-based tax. When we're talking about capital gains, we're talking about a federal tax. Okay. So how much is it? If that change in rezoning increases the value of the capital improved value by less than $100,000, there's no liability. If you're between $100,000 and $500,000 increased, then it's 62.5% of the excess over $100,000. So we just put the example there to say, if you've got $300,000 uplift, $200,000 that is taxable at 62.5%, which is $125,000. So just get the reality of that is a theoretical increase in valuation on your property by $300,000. Of that, $125,000 is not going to be yours. Let's not make comment on what we think about the logic of it. And then the uplift that's greater than 500,000, well, it's a slap bang 50%. You're handing over 50% to the Victorian state government for the uplift in value because of this rezoning. Now, there's some really critical pieces here, though, and I saw one comment that said, this is crazy. Agreed. Agreed. That's the only way we could say it. However, here it is, and here's what we've presented with. I want to talk about this, though, in particular. These are some really, really important things to know about it. And it can apply to defer your payment. However, it's really important to understand that that application needs to happen before the due date of the assessment. Okay, so if you're in this world where you receive one of these assessments, you have until the due date of the assessment to apply for your deferral. There's a particular form that you need to actually use to apply for it. The deferral can be for up to 30 years. The reason I say up to 30 years is because there may be trigger events between now and the 30 years that say the deferral is no longer relevant. And the most obvious one is you sell the property. So if you sell the property, what will happen is part of your proceeds of sale will be redirected to the State Revenue Office on that settlement. Really important to note too also that if you do defer, which deferral makes complete sense unless you've got money laying there that you don't sort of use, interest will be payable on that deferral, and that's at the Treasury bond rate. So it's lower than bank interest rates, but there's a charge to actually defer it. And think through the compounding factor of interest, it can defer, while the deferral can be good, 30 years of compounding is pretty serious money.
The trouble is as well, Tim, like, where do people get this money? Because often it's not on a sale, is it? It's a rezone, and it's quite often not even the owner who was asked for the rezoning. The council's just decided, our planning proposal is to expand this township or whatever. We're rezoning. And if they don't have an accountant that they regularly see, because they're not engaged with a lawyer because there's no transaction actually happening. Like, how are they going to know this time frame? It's just scary.
It is scary. Even to the point of, imagine if you got and you missed the notice of assessment. You just in all your mail and the like, you missed that notice of assessment. You've missed the window, and you're gonna be up for the money here and now.
That's right. Grey nomads going away for 3 months over winter.
Yep.
Hmm.
Yep. It's got nothing to do with whether you sell your property or you even plan to develop your property. It's just a choice that the government have made to say you're liable. Job done. I always try to find one piece of silver lining if I can. And the piece of silver lining here is that anything you do pay, so in the example before we might pay 125,000, that actually will add to the cost base of the property. So you will pay less capital gains tax as a result, but make no bones about it, you're still out of pocket more than you would have been if you had to pay the capital gains tax.
And to
So-
clarify again, Bernadette's just saying, so this windfall gains tax is payable even if you haven't sold. Yes. So you don't
Yes.
have money coming in. It's just an on paper increase in the value of your property.
Yeah, very much. They use a term from my reading about around liability. So it's a liability that's payable at some point down the track. Yeah, really important thing to consider here, and this is where solicitors really, really critical when doing these types of sales, is considering the what ifs. What if there was a rezoning that took place between contract date and settlement date? Now, it may well be you're going to settle in 60 days and they think there's no risk, but just imagine it did. More likely, what about if you had a settlement or a contract on terms where you're going to settle for maybe 12 months, 2 years? And you may think you're outside the zone, you may think you're near a zone. It really comes down to a negotiation process because the liability sits with the person whose property the name was in at the time of the sale. So if the property sale was happening in the rezoning was happening in 2024, and you had a contract in place at, let's say, the 31st of December 2023 to sell the 31st of December 2024, you are the person liable for that amount payable, and they'll be withheld from the proceeds of sale. So negotiation becomes critical, and clauses in contracts become critical around, okay, if this was to happen, who would be liable for it? I've also put a reference there for the State Revenue Office for their frequently asked questions, which there's not a lot of good news in that page, but there's news in that page. So you can look up any particular issues, specific situations. There are some other exemptions, like things like charitable organisations and the like, but I'll try to keep it relatively relevant here as we go through it. So we talk about this a lot between the windfall gains tax, and the question before was asked about the 20 years worth of records. Yeah, it's a pain, absolutely. But records are the best kept. So we would suggest the ideal world, you keep your source documents, starting with the contract of purchase and the settlement statement. Please keep the settlement statements. They're really useful. And details of your stamp duty you've paid right at the front end. So that's the starting point. On the way through, yeah, it is easy to lose records. We understand that. And it's not always a great thing to have to keep every single rates notice for the last 25 years. Absolutely do your best and try to keep them all. Having said that, if you were to show reasonable behavior in the sense of, and we suggest like a spreadsheet, it's really simple to do this, or the simplest way we could think of anyway, logic is run one spreadsheet, which then you put the nature expense, the date of the payment, supplier you paid, how much you've paid, and what you're allocating it to the cost base. Where are you allocating? Are you allocating it to outside the 5 acres, inside the 5 acres? And that might be tricky to do at different times, but it's about just keeping the records as best you can. If you were to keep the rates notices for most of the years, and 3 or 4, maybe even 10 over the time weren't there, but you show consistency of records through your spreadsheet, I think you'd have a fairly good argument with the ATO. Technically speaking, I should say keep every single record, but the reality is we all know how the real world works. The other thing I really want to talk about is timing. And this is critical knowledge. In the original example we did with Jim and Pam. If I go back to that for a moment, is we talked about the sale was happening on the 15th of May and settlement was the 15th of August. Bear in mind the Australian tax year finishes on the 30th of June. The critical date is the date of the contract, not the settlement date. So in that example, the tax liability, capital gains, related to the 2024 financial year, not the 2025 financial year when the settlement took place. A lot of people on the sale of a property go, oh, good opportunity, and this is where we work with our planners and the like. So great opportunity to put a big chunk into super and really brisk the super up. What an outcome. However, if you do that in the subsequent year, so the 2025 financial year, you do it after settlement in August, you've missed the boat. You've still got the liability for your capital gain from the previous year. So if I can suggest anything, it's to really get proactive around this. Engage with your solicitor, engage with your planner, engage with your accountant to say, hang on, what are we doing here? How's the cash flow going to work? We've had situations where clients have gone and borrowed money to be able to put the money into super prior to 30th of June and then settled after 30th of June, happily paid the interest on that borrowing because it was cheaper than what they would have missed out for their tax losses or tax consequences, I should say, as a result of not putting that through. So I really wanted to get that message across that timing is critical, but engagement is critical too. Engagement with the people around you who actually do this on a regular basis. One of the challenges we find is that for most people, selling a property is maybe 2-3 times a lifetime event. The truth of the matter is that we are fortunate enough to be able to deal with that on a regular basis because we see a lot of clients. So please don't be afraid to engage for support and help through all your professionals around you. And so to that extent, so I suppose there's a bit of an announcement from me with Jackie here as well. And the line is, this will be the last time we'll be doing an event as Sage Business Group. As of this week officially, we'll become Blackwood Advisory. And why that's really relevant to this conversation here is the next slide, which is what it allows us to be able to do. So it allows us to provide the tax and accounting work that we've provided for a number of years, over 30 years now. But where it becomes really relevant is talking about financial advice. So we've got a full financial planning division and a financial advisory division within Blackwood Advisory. We've got retirement planning, superannuation planning, and working with Jackie, wills and estates. So you can imagine that one transaction happening on selling a property, and the number of tentacles that come off that is significant. And so therefore, what can Blackwood Advisory do? It actually can help you try to bring all that together, working with Jackie to make it as, I won't promise to be seamless because it's never seamless. That's rubbish. What it is though, it's as effective as possible for you and your family's needs. And that's really, really important. So the other really relevant piece about Blackwood is that we're servicing regional areas. So now we have 7 offices where we can service. In addition, you can add to that, Jackie's obviously in the Gambia as well. So add to that on top of this in Seymour. There's a service here for people in regional areas to be able to learn from and to probably get the financial resourcing that they should be able to get. Yeah, we don't have to go to Pitt Street or Collins Street to actually get great advice and great service. So yeah, so that's very exciting. For us, it's very exciting. Hopefully someone else is excited about it, but we are anyway. So awesome.
Yeah, congratulations. I think it is very exciting to bring together the arms of your business that you've been planning to bring together for a long time all under one banner. And as you say, and as people here today understand as well, because we're on a Zoom call, you can work with anyone anywhere now.
Yeah.
So you've got good people that don't work on Collins Street in Melbourne.
Yeah, that's right, exactly. So yeah, so thank you, Jackie, for the opportunity to be able to run through this. I really appreciate the opportunity to be able to talk about what is a heavy topic, but also to introduce what's coming up in the future for us as well.
Well, I think everyone was really engaged. There were some really good questions there. And the windfall gains tax always just gets me worked up because it's terrifying and it just feels like such a rort. But anyway.
Yep. I don't know anyone who said it's a great idea.
Yeah, except state government.
Yeah, good point.
So if there are any other questions, please drop them in the Q&A. I am going to stop the recording so we can have a little bit of a chat with those who are on live. Those who are watching the replay, unfortunately, you don't get a chance to have a chat one-on-one. But Tim, share your email address as well.
Yes, so my email address is tim.mccarthy@blackwoodadvisory.au. So there's no com. So if you get that tim.mccarthy@blackwoodadvisory.au.
Perfect.
I'm about to get very used to saying that. It's been hard.
Yes. And of course, if you get the replay, you'll have the email addresses for TBA Law anyway. And if you can't find Tim because you put the .com in there, you can always ask us and we can shoot you his email anyway. So let's have a look at some questions.